Good afternoon, and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. Before I introduce today's presenters, a few quick reminders. Everyone that is registered for today's program will receive a copy by the end of next week. And if you have any questions, feel free to enter them into the lower right side of your interface under the Q&A bar. Today's presenters from Moss Adams are just as you'd expect, pros. We have tax partner Matt Solomon, along with tax managers Brittany Richards and Brianne Eagles. So now I'll let them do the talking. Take it away, guys.
So hello, my name is Brianne Eagles. I work with Moss Adams Medford location, where I work primarily with clients in and related to the dealer services industry. I've been in public accounting since 2006, providing tax and consulting services, and we are looking forward to discussing the uncertainties of today's tax environment and appreciate you all being with us.
Hello, my name is Brittany Richards. I am a tax manager here with Moss Adams, located in our Portland, Oregon office. I've been with the firm for about 7 years now and work primarily with clients in the automotive and real estate industries. We're very excited for you to be joining us today for a discussion about where we're currently at as it relates to tax law and where we're headed. We'll explore areas that are highly susceptible to reversal under a new administration, as well as discuss ways to hedge against future changes and the steps that you can take now to maximize our current tax environment.
So we'd like to start with a refresher of where we are today under the current tax law. The Tax Cuts and Jobs Act of 2017 had a significant impact to most taxpayers. Corporations went from paying a top tax rate of 35% down to a top tax rate of only 21%. And owners of pass-through entities, so we're talking S corporations, partnerships, most of them are eligible for the qualified business income deduction, which in pretty simplified terms is a deduction at the individual taxpayer level equal to 20% of their qualified business income. Along with lower tax rates, tax reform brought with it an increase in bonus depreciation as well. Under current law, taxpayers can take 100% bonus depreciation on depreciable asset purchases. This is scheduled to phase down over the next several years, sunsetting completely at the end of 2026. Tax reform wasn't all good news, of course. We did have the introduction of the business interest expense limitation. Entities' interest expense may be limited if it exceeds 30% of adjusted taxable income. Thankfully, dealers were able to get a carve out in the law that is allowing them to exclude their flooring interest paid from the limitation calculation if needed. This carve out does come with a cost, though. If a dealer needs to exclude flooring interest paid from that calculation, they are prohibited from using bonus depreciation. So those are some of the issues around tax reform that we see impacting our dealer clients the most today. And Brittany is going to walk us through what we might need to consider under a new administration.
Thanks, Brianne. Now that we're caught up a little on where we're at and the various changes implemented as part of the Tax Cuts and Jobs Act in 2018, let's chat a little about what areas are generally highly susceptible to reversal in a new administration. In our current political environment, there's always a buzz around tax regulations and a lot of speculation about what changes could be coming down the pipeline. One important factor that always is up for debate is tax rates in general. As Brianne discussed, the top corporate tax rate was reduced to 21% under tax reform. The top tax rate for individuals was also decreased from 39.6% to 37% for those in the top income earning tax bracket. Not only have many speculated that the top rate of the 37% may increase for high income levels in the near future, a lot of the provisions under the Tax Cuts and Jobs Act will cease to apply after 2025 and will then revert back to the pre-2018 law. So what will happen if the qualified business income deduction goes away? Since the qualified business income deduction for pass-through entities was the lawmakers' attempt at aligning those lower corporate tax rates with pass-through income from businesses structured as partnerships and S corporations, it's highly likely that if the qualified business income deduction does end up sunsetting in 2025 as currently planned, the feds will most likely adjust the corporate tax rates accordingly. They may not jump back to 35%, but no one really knows at this point. Additionally, there's a possibility that the 20% exclusion for qualified business income may become more exclusive as to who actually qualifies for the additional deduction. So even if it's not eliminated outright, the number of taxpayers benefiting from the deduction could drastically decrease the qualifications if the qualifications change under the qualified business income deduction.
Another deduction we could see phased out sooner or faster than currently scheduled is bonus depreciation. If you recall from our first slide, bonus depreciation is 100% from now until 2022, and then it phases down 20% per year from 2023 through 2026. Less favorable changes to bonus depreciation may not actually have as much of an effect on dealers as you might expect. We have the interplay of the interest expense limitation to consider as well. So the interest limitation calculation changes at the beginning of 2022 when we are no longer able to add depreciation back to adjusted taxable income for purposes of the interest expense limitation. So this is likely to lead to more dealers needing to utilize that floor plan exception and therefore not benefit from bonus depreciation anyway. Another item is LIFO repeal. Inventory methods such as LIFO and lower cost or market are often a topic of discussion when tax law changes are proposed. These are widely used tax strategies in many different industries, and their elimination could serve as a tax revenue generator. However, it is likely that in the event that these inventory methods are repealed, that the recapture of the LIFO reserve would be spread out over at least 4 years, lessening the immediate impact to the taxpayer.
Awesome. So now that we've talked a little bit about the areas that are more susceptible to tax law changes, how can you actually hedge against these future changes? One strategy to consider is to trigger a recapture of your current LIFO reserve over a 4-year period. As Brianne just mentioned, the repeal of LIFO is always a hot topic in the midst of any major shifts in administration or in cases of tax law overhaul. Here's a few scenarios where it might be worth it to explore triggering a LIFO recapture event. Consider your 5-year business plan. Are you anticipating a sale of the dealership in that time period? If that's something that's on the horizon for you, then the full LIFO reserve will be recaptured at the time of the sale anyway. So it might make sense to consider recapturing your LIFO reserve now with the tax due in 4 installments. This will provide you with some greater flexibility over your cash flow and will allow you to take full advantage of the lower tax rates while they're here. Additionally, if your LIFO reserve is small and not providing much additional benefit, consider recapturing to reduce the administrative burden and again to take advantage of these low tax rates under the current administration. We'll discuss this point a little bit more in depth on a subsequent slide, but it's also worth considering a corporate restructure that would maybe structure from a C Corp to converting to an S Corporation, which would then require a LIFO recapture. With the LIFO recapture, the taxes again would be paid in 4 equal installments. The LIFO election would remain in effect under the new S Corporation, but you'll recapture the total LIFO reserve just prior to the conversion and start fresh with a new layer and a carryover index. This can be a great strategic play if the fact pattern is right for you.
So now we have a polling question we'd like everyone just to take a moment to consider. what is your largest tax deferral item? So is it depreciation? Is it your inventory reserve, or is it something else entirely? So we're really just asking this question to encourage you to identify which of these items you may have now and what effect the reversal could have on your taxable income and your tax liability. It is really important to understand the timing and the impact of deferral items so you can be prepared for tax law changes. If we do end up under a new administration and we see which potential tax law changes may be on the horizon, we will have the opportunity to model out what the reversal of deferral items will look like. So knowing those items becomes essential. And of course, under current tax law, we should already understand what the timeline for reversal is and be considering the items that are scheduled to phase down over time. So are there things that you should be doing now to prepare for the scheduled decrease in bonus depreciation? Or should you be doing things to plan for the scheduled sunset of a qualified business income deduction?
So we've discussed where we're at, what could change, and then ways to hedge against these changes. Now let's talk a little about what steps you can take now to ensure that you're maximizing the current beneficial tax environment. One of the biggest areas to consider as it relates to strategic analysis is to revisit your entity structure. Now might be the time to consider converting from a C corporation to an S corporation to take advantage of the qualified business income deduction. And as well as we discussed earlier, this would trigger a LIFO recapture over 4 years. Additionally, it's important to confirm that you are appropriately grouping and aggregating your business entities in order to apply the 20% qualified business income deduction to your rental activities. A very common dealership structure is to have the operations inside of an S corporation and then the real property inside a rental real estate LLC. In general, most rental real estate LLCs would not qualify for the business income deduction by themselves because they would not rise to a level that the IRS would consider a trade or a business activity on its own. However, if you elect to group the dealership S corporation and the rental real estate LLC as one business activity, you can take full advantage of the business income deduction at the LLC level as well as at the dealership S corporation entity level. Another thing to keep in mind, it's important to ensure your related party rents are reviewed to confirm that market rents are being charged. Otherwise, you can run into self-rental issues. And out of curiosity, another polling question for you. Have you changed your entity structure due to tax reform? So we'd like you guys to think about that a little, and then when we open it up for Q&A in a moment, we'd love to hear your thoughts and responses.
So we're currently in a pretty taxpayer-friendly tax environment right now. Ordinary income tax rates are low, capital gains rates are low. If we end up with increases to tax rates or the repeal of beneficial tax treatment, we should all know well enough in advance that we can plan for it. And something we may all be considering at that point is whether it makes sense to accelerate income into the last year or years of the favorable rates. So whether that could be ordinary income or capital gain income, are we thinking about electing out of LIFO and bringing in the recapture at that lower rate? Do we slow down our depreciation and save deductions for a future year when the rates are higher? Are you planning a sale and you're considering moving it up to take advantage of low capital gains rates? And of course, there are so many factors that would need to be considered to make a decision of whether any type of income acceleration strategy is the right call. But the risk and opportunities should be able to be modeled out to enable you to make an informed decision that fits your own tax situation.
So another big thing to consider as we're talking through tax reform, potential future changes, is what's your end game? Do you have an established succession plan? Now is the time to explore estate and gift planning while exemptions have been doubled under the Tax Cuts and Jobs Act. Pre-2018, the lifetime exemption was $5.5 million for the individuals and $11 million for married taxpayers. However, beginning on 1/1/18 through 12/31/25, the lifetime exemption has been bumped up to $10 million for individuals and $20 million for married taxpayers. You should definitely be meeting with your CPA and your legal advisors to ensure that your will and estate documents are in order and that you have a solid exit strategy planned out. That concludes the planned portion of our presentation today. And what we'd like to do now is open the forum up for questions. We've got one other on the call, Matt Solomon from our office, that is going to be helping us field Q&As. So Matt, would you like to introduce yourself to the group?
Yeah, thank you, Brittany. My name is Matt Solomon, and I'm a tax partner with Moss Adams, and I'm based out of Portland, and I've been working with dealers of all shapes and sizes for about 25 years.
All right, it looks like we have one question that's come through. So did you see a lot of dealerships converting to C Corps to get the 21% tax rate? So Matt, do you want to take this one?
Sure. It was a hot topic for discussion, certainly, but in the end, I think for the most part, after looking at all of the factors, it didn't make a lot of sense long term for those that were not already in a C Corp structure. With a C corporation, the current tax rate is very attractive, but there are some significant downsides to a C corporation that don't do the best job of facilitating things like transition planning, the sale of a dealership, for example. And so really it all comes back to something that you guys mentioned a couple of different times during your presentation, which was any contemplated major change to your structure really demands some rigorous modeling to determine what the current impact is, as well as the long-term impact, and how does it play in with your strategy for an exit down the road.
Any other questions coming in? For those of you on the call, what has been your biggest pain point in dealing with tax reform? Feel free to respond in the Q&A window, but we'd love to hear what you have experienced.
And I'd say from our clients' perspective, what we were seeing a lot of, varied, but so much of it was just there were so many changes all at once that trying to understand how it all affected them and what they could be doing. It didn't come down to just one thing. It came down to everything, which made it, somewhat challenging to navigate through. But overall, everything had to be considered.
And I think as we get into year 2 and figuring out how the changes will roll into year 2 compliance and tax reporting, it's going to be a whole nother challenge in and of itself.
The most difficult part from my perspective was that we really didn't have complete guidance until the very end of the extended filing season, and that made it a real challenge to plan and advise our clients. but in the end, year two, I think we have a lot more knowledge, we have a lot more experience, and we've had a lot more buy-in and weigh-in from different stakeholders that have impacted the regulations that have been issued. You mentioned it earlier. There was significant political influence that impacted 163J, for example, which are the interest expense limitations and the regulations that came out in the final hours of the extended filing season were ended up being favorable for dealers. But it took a lot of doing to get there.
It required a lot of lobbying.
Yeah, a lot of last minute changes. Another question, looks like we've gotten in. What do you think the likelihood is that LIFO will be repealed?
I think that it's been talked about, repeal has been talked about for as long or close to as long as I've been practicing. And the reason is it is used by every industry with inventory, and there's a reason for its use. It's very effective as a tax strategy. So because it's so widely used, the revenue that would be generated from a repeal of LIFO would be significant. And so I don't have a perfect crystal ball, but I can see in the future that as demands for revenue, tax revenue increase, just look at the growth of government, look at the changing demographics that are going to require social services, which are paid for by taxes. I've got to think that in the next 10 years, you see some significant change to LIFO.
So we've got another one. If there is a change to the administration, how long would it take for tax law changes to come into effect?
Well, it's not immediate. We saw with the last administration, the House and the Senate have a say over how proposed tax law changes are implemented and the regulations around them, so the actual nuts and bolts of how they apply to taxpayers. The last administration, though, with the significant majority that they had, they were able to push through some significant changes within about a 2-month period, and but they're prospective changes. So the idea of retroactive changes is much less likely. Prospective changes, if there's enough of a majority, those things can happen relatively quickly, but not immediately.
Any other last minute questions? If not, you can pass your questions along to me, Rachel Soleimani. My email is solimanir@aiada.org, and I can pass them along to them for you guys. Matt, Brittany, and Brianne, thank you so much for taking time on your busy schedules to speak with us. This is a really important topic and it's always changing, so we appreciate it. Those attending NADA this weekend, be sure to stop by booth number 4895C and say hi to the awesome Los Adams crew. For more information about AIADA, visit aiada.org or call 1-800-GO-AIADA. Thanks for joining us and have a great afternoon.